Welcome to Furniture Industry News. Today is Thursday, May 28, 2026. Thanks for tuning in. This week's briefing is a tight one, but the three stories we have are big. Department store traffic just had a rough first quarter. The federal government has started writing massive tariff refund checks to U.S. importers. And the latest Surkana report shows April retail spending slipping more than the top line suggests. Each one points in the same direction. The consumer is being selective, and the operators who read the segmentation directly are going to pull ahead this summer. Let's start with department stores, because the latest numbers from Placer.ai tell a story every furniture and bedding operator should pay attention to. According to Placer's recent report titled The Department Store Divide, most major department stores lost traffic in the first calendar quarter of 2026. Among chains with dedicated home departments, only Boscov's grew. Its overall visits rose just under 1% year over year. Every other major name in the category went the other direction. The roughest quarter belonged to Macy's. Overall visits fell 10.2% year over year, and visits per store fell about 3.8%. That's a meaningful drop for the largest traditional home and apparel anchor in the country. The data also covered Bloomingdale's, Dillard's, JCPenney, Kohl's, Nordstrom, Saks Fifth Avenue, Von Maur, and Boscov's. Almost all of them declined. Here's the data point that should be circled on every operator's calendar. Saturdays accounted for more than 25% of all department store visits during the quarter. That's well above the 17% average for non-discretionary brick-and-mortar retailers and the roughly 22% average for other discretionary chains. In other words, department store traffic, and by extension a lot of home and bedding traffic, is heavily concentrated on Saturdays. That matters because March of 2026 had one fewer Saturday than March of 2025. Placer.ai specifically called out that calendar shift as a key driver of the soft quarter. If you've been reading your weekly comps and wondering why March looked weak, the answer is partly that there was simply one fewer high-traffic day in the month.
The April data offered slightly more encouraging signs. Bloomingdale's visits rose about 1.7%. Kohl's narrowed its gap from down 11.5% in March to down just 1.4% in April. Macy's gap narrowed to about 2.4%. So there's a stabilization, but the broader pattern is clear. Premium, experience-driven chains continued drawing shoppers through the slowdown. Mid-market players were the most exposed to the macro pressure. For furniture and bedding retailers, the actionable takeaway here is the Saturday concentration. If a quarter of your category's traffic is moving on one day, you have to plan staffing, deliveries, and promotions around that day. You also need to read week-to-week comps with the calendar in your hand. A down week may simply be a week with a missing Saturday. Don't draw the wrong conclusion from that. Now, on to the second story, which is a significant one for any business that imports furniture or bedding components. The federal government has begun returning billions of dollars in tariff payments to U.S. importers. These refunds stem from a Supreme Court ruling earlier this year that struck down a range of tariffs imposed under the International Emergency Economic Powers Act, known as IEEPA. The court ruled that the prior administration exceeded its authority when it imposed sweeping tariffs without congressional approval. That decision invalidated tariffs affecting imports from China, Canada, Mexico, and a wide range of other trading partners. Here are the numbers. U.S. Customs and Border Protection has already processed more than $20 billion in refunds, according to court filings and reporting from The Guardian. Total refund liability is estimated somewhere between $130 billion and $175 billion. Tens of billions more are expected in the coming months. CBP launched its refund processing system called the Consolidated Administration and Processing of Entries, or CAPE, in April. The first wave of refunds was expected to begin around May 11th, per Reuters. Court filings now show millions of entries already moving through the pipeline. Large retailers, manufacturers, and logistics companies have filed for refunds, including Walmart, General Motors, and FedEx.
Here's the catch. About 15% of the refund claims submitted so far have been rejected because of filing issues or incomplete information. That's the warning signal. This is not an automatic process. It is driven entirely by the quality of the filings. If your customs broker hasn't reached out to you yet about this, get them on the phone this week. The cash is real, but it has to be claimed properly. Two more important points. First, these refunds apply only to tariffs imposed under IEEPA. They do not cover Section 232 tariffs, Section 301 tariffs, or anti-dumping duties. If your import categories were affected by those mechanisms, you are not getting that money back. Second, Even with the court ruling, the administration is pursuing other tariff mechanisms, including temporary duties under Section 122 of the Trade Act of 1974 and potential future Section 301 actions. The cash relief is real, but the tariff exposure is not over. Now to the third story, which is the latest Surkana retail spending data. The headline number was rough. Overall retail spending in April was down 1.6% compared to April of last year, and unit demand fell 4.7%. That's a meaningful decline. Some of that is calendar-driven. Easter shifted from April 2025 into March of this year, creating an unfavorable year-over-year comparison. Surkana flagged that as a major contributor to the April softness. They also noted that elevated pricing in certain categories last year, particularly eggs during the avian flu outbreak, made the comparison even harder. But within the numbers, there are some signals worth pulling out. Discretionary general merchandise revenue fell about 2.1%, but unit demand in that category fell 10.9%. That gap, dollars down a little but units down a lot, is the most important data point in the entire report. It tells you that consumers are buying less stuff at higher prices, not more stuff at any price. That's not a sign of underlying category health. For the 4 weeks ending May 2nd, food and beverage dollar sales were down 1.7%, with units down 4%. Non-edible consumer packaged goods revenue dipped about 0.7%, while unit demand was down nearly 6%. Across the board, dollar declines were smaller than unit declines, which again suggests price is doing the lifting.
Marshall Cohen, Surkana's chief retail industry advisor, framed it this way. He said, quote, "There is no longer a one-size-fits-all consumer," end quote. He pointed out that year-to-date retail results still reflect modest growth despite the April dip, and he urged retailers to look past any single month for signal. The most interesting piece of the Surkana report is about behavior shifts among younger consumers. Surkana described what they call a longer-term reset. Younger households are doing more crafting and entertaining at home. They're growing their use of do-it-yourself solutions, including auto maintenance. Surkana compared the pattern to behavior we saw during the pandemic. The conclusion is that younger consumers are reallocating spending in a structural way. They're putting more of their dollars into the home itself. That's a furniture story disguised as a food and hardware story. The household is becoming the venue. For furniture and bedding operators, the playbook is to merchandise and market around how younger consumers are actually using their homes. That means entertaining-driven dining settings, multi-use living rooms, better home offices, bedrooms that double as wellness spaces. Older consumers who are financially stable remain a key source of growth, but their spending is not unlimited. Different demographic groups are reacting differently, and that's the segmentation operators need to lean into. A couple of quick items to close. The premium versus mid-market split that Placer.ai flagged is the operating environment for the rest of 2026. Premium, experience-led retailers are pulling away, and mid-market chains are the most exposed. Reflect that in how you position, market, and assort. And on the tariff side, again, if your importer hasn't filed yet, the 15% rejection rate tells you that documentation quality is the gating issue. Don't assume the refund just shows up. That's the briefing for this week. The consumer signal is consistent across all three stories. Selectivity is up, dollars are not chasing volume, and younger households are quietly resetting where their money goes. If you find this briefing useful, please subscribe so you don't miss the next one. Thanks for listening to Furniture Industry News.